like all banks during all banking crises, almost every bank, I shouldn't say all, most banks do, from Silvergate in this case. Remember, they would come on CNBC all the time saying we're fine. Silicon Valley Bank, this bank, that bank. It's bad. Like, it's one thing to insure the deposits of the people. I don't know if many people actually believed, first of all, Josh, that their deposits were actually at risk. Like, I don't think that was ever a thing in American psyche or society. Most people probably didn't even know what the FDIC number was. I don't mean most people on Wall Street. I mean most people. So it's such a low bar, like in terms of like trying to fortify that. But the other side of the trade, all the bad behavior. I mean, it's not like you have an administration that's like, in particular Elizabeth Warren, that's allowing for these banks to like just take a little slap on the wrist and I'm going to make all your deposits safe and let you go back to doing what you're doing. I mean, like you said, just mark to market alone is a huge change in terms of how these people do business or these banks do business. And I assume that there's a much bigger social contract on the other side of it, which probably mean that your numbers that you started with on loan growth are too conservative, right? Because you're assuming prior lending standards, prior like tomfoolery and shenanigans by whatever bank in whatever state and under whatever auspice. So, I mean, that's trying to summarize a lot of what you said, but it just brings it back to today, which is, today you're going to have the banks open up again and you're having another day to make a decision. Like, is it all good? Is it all good?
Yeah, I think it's important to sort of keep perspective on, there's really two things going on here simultaneously. And as we like to talk about, there's sort of a sine wave within the sine wave. So, the shorter sine wave, the shorter duration, smaller sine wave is this liquidity crisis that is obviously driving multiple bank failures and, a collective sort of psychology phenomenon that is, the sort of focus at the moment. But within the broader sine wave, what's happening is what's been happening really for now going on, 5 quarters in a row, which is this deteriorating backdrop. Obviously, I spent time talking about the tightening underwriting conditions, what that's going to do to loan growth. The other element to this is, if you think about, and I didn't even sort of bring this in earlier, but you brought it up. If you think about the sort of regulatory reaction function here, and then what banks' reaction to that reaction function is, obviously it's not overly encouraging either. I mean, think about it, right? You think as a result of this, regulators are going to be basically loosening restrictions or regulations on the banks from either a liquidity or a capital standpoint. You think banks will expect that to be the outcome? No, it's the exact opposite. And as a result, that too is going to get them to basically pull in their horns, right? So, yeah. So I think there's a lot going on here, and that's all within this larger, broader sine wave. Even if we're getting these sort of short term, well, today a bank didn't fail, so the stocks go up, kind of dynamic. So keep perspective on the bigger picture, obviously the smaller, shorter term picture as well. But, you got to differentiate between the two.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.